Imagine walking into a giant mall, but instead of buying shoes or phones, you're buying tiny pieces of companies, not the building, not the CEO's chair, just a microscopic slice of ownership. And here's the strange part. Those tiny slices can make you rich or quietly take your savings away. That's the stock market, and most people are either afraid of it or blindly in love with it. Let's understand it like you're 5, but without treating you like one. Right now, trillions of dollars move through global stock markets every single day. In the United States alone, the value of all publicly traded companies is over $40 trillion. In India, it's crossed $4 trillion. These are not small numbers. These are economies inside economies. So why does this matter to you? Because whether you invest or not, your job, your pension, your bank balance, even your country's stability is connected to this machine. Let's shrink it down. Imagine you and 4 friends open a lemonade stand. You need money to buy lemons, sugar, and a table. So each of you puts in 100 rupees. Now the business has 500 rupees. Each of you owns 20%. That ownership is called a share. If the lemonade stand makes profit, you split it. If it fails, you lose your money. Simple. Now imagine instead of 5 friends, there are 5 million strangers. And instead of a lemonade stand, it's a company like Apple, Reliance, or Tesla. That's the stock market. Companies sell pieces of themselves, called shares, to raise money. Investors buy those shares hoping the company grows. But here's where it gets interesting. When you buy a stock, you're not buying it from the company most of the time. You're buying it from another investor. The market is just a giant auction house. Prices move not because of what something is worth, but because of what someone is willing to pay. If more people want to buy a stock than sell it, the price goes up. If more want to sell than buy, the price falls. That's it. No magic, just supply and demand. But wait, if it's that simple, why does it feel so complicated? Because price is not value. Let's go back to the lemonade stand. If it makes 100 rupees profit every year and you own 20%, you get 20 rupees per year. Now imagine someone offers to buy your share for 200 rupees. Would you sell? You invested 100. You're making 20 per year. That's a 20% return. Sounds great. But if someone pays you 200, now the new owner is earning 20 on 200. That's 10%. Same business, same profit, different price. That difference is the market. Stocks move not just on profits, but on expectations of future profits. If investors believe the lemonade stand will open 100 new branches next year, the price jumps today, even if nothing has changed yet. This is where hype enters. In 1999, internet companies with no profit were valued at billions just because people believed the future is online. They were right about the internet. They were wrong about the timing. Many stocks crashed 80 to 90%. Belief moved faster than reality. Fast forward to 2008. Banks were packaging risky loans and selling them as safe investments. Housing prices kept rising. Everyone believed it could never fall, until it did. The stock market lost more than half its value in months, not because businesses disappeared overnight, but because confidence did. The stock market runs on 2 fuels, earnings and emotion. Earnings are slow and boring. Emotion is fast and explosive. In the short term, emotion wins. In the long term, earnings win. Here's the uncomfortable math. If a company earns 10 rupees per share per year, and the stock trades at 100 rupees, investors are paying 10 times earnings. If excitement pushes it to 300 rupees without profits rising, now they're paying 30 times earnings. The higher that number goes, the more perfection is expected. And perfection rarely happens. That's why markets rise gradually, but fall suddenly. Greed climbs stairs. Fear jumps out the window. Now, zoom out. When you buy a stock, you're making a bet on 3 things: the company, the economy, and human psychology. You can analyze balance sheets, you can study growth rates, but you cannot fully predict fear or euphoria. That's why even professionals get it wrong. And here's the irony. Over the last 100 years, despite wars, recessions, pandemics, crashes, the overall stock market has trended upward. Patient investors who held diversified portfolios historically built wealth, but the journey was never smooth. Some years you gain 30%, some years you lose 40%. The stock market is not a straight line, it's a heartbeat. Flat line means death. Volatility means it's alive. Now the part nobody likes to hear: the market does not care about your goals, doesn't know you need money for a house next year. It doesn't adjust because you feel nervous. It moves based on millions of decisions happening every second. And sometimes those decisions are irrational. So what is the stock market really? It's a system that allows companies to raise capital. It allows investors to participate in growth. And it constantly translates human optimism and fear into numbers on a screen. It is rational over decades, irrational over days, and unpredictable in between. Right now, as you're watching this, algorithms are trading in milliseconds. News headlines are shifting prices in seconds. Social media can inflate a company's valuation overnight. The machine has never been faster, but the core idea hasn't changed since the first stock exchanges opened centuries ago. Ownership, risk, reward, and belief about the future. So when someone says, the market is up today, what they really mean is this: on average, people feel slightly more hopeful than afraid, and when it's down, fear is louder. The real question isn't whether the stock market is good or bad. It's this: can you handle owning a piece of a system driven by both math and madness? Because understanding it is simple, living through it is something else entirely.